Welcome to the Deep Dive. We're here to cut through the noise and really get to the heart of what's shaping our world. And today, well, we're diving into incredibly dynamic, high-stakes world of global finance. Specifically, we're looking at that really pivotal moment when a private company decides to go public, the initial public offering or IPO. Think of it like this huge, thriving family business, maybe built up over decades, suddenly deciding, okay, let's invite the whole neighborhood in, let everyone have a piece of the future. It's a massive transformation, right? But traditionally, that journey, it's been pretty complex, often quite rigid, especially for the really big players.
Exactly. And that complexity, that rigidity is precisely what's been tackled now. Our deep dive today is all about India's securities regulator, SEBI. They held a really landmark board meeting back on September 12th, 2025. And this meeting, it wasn't just about tweaking a few rules here and there. No, they unveiled a whole sweeping set of updates designed to fundamentally smooth out that IPO journey, particularly for the larger corporations. What we're seeing here, I think, are changes that could inject some serious new energy into India's capital markets, which are already buzzing, let's be honest. It really solidifies India's position on the global financial stage.
Right. So our mission today is pretty clear then. We're going to unpack these big reforms. You want to understand the why behind them, what's the thinking, and crucially, the what does it all actually mean? For India's economy, which is just booming, for global investors who are always looking for that next big opportunity, and yes, even for you, the everyday investor, maybe looking to get a stake in some of tomorrow's potential success stories. Okay, so let's set the scene a bit more. Picture a truly enormous company. Maybe it's a tech behemoth that's completely changed how we do things, or perhaps a sprawling conglomerate, with fingers in everything from infrastructure to everyday goods. This giant company, it's ready to share its success, go public. Now, before these recent changes, companies like this faced a pretty daunting challenge. They basically had to offer a really substantial chunk of their shares, often 5%, or even more of their paid-up capital. That's the money investors already put in.
That's right, the existing capital base.
So 5% or more right off the bat in the IPO. Now, imagine a company aiming for a valuation post-listing of several trillion rupees.
Huge numbers.
Huge. That 5% meant they had to raise, tens of thousands of crores? Billions of dollars, essentially, all in one go. And that kind of massive share dump, well, it could easily flood the market.
Absolutely. Creates volatility.
Exactly. Huge price swings. And frankly, it can make potential investors pretty nervous. It was like walking a tightrope.
That's a really good way to put it. And SEBI, recognizing that exact dynamic, they've taken a remarkably proactive stance here. They clearly understood the need for balance. How do you help these corporate titans access the vast capital they need for growth while also making sure the market stays stable? It's a critical balancing act.
And their solution?
Well, it's the strategic recalibration using tiered norms.
Yeah.
These are basically rules tailored to the company's expected market capitalization after listing.
So not one size fits all anymore.
Not at all. What SEBI is signaling is essentially, look, the biggest fish can now swim into the public market with let's say, less splash. A smoother entry. Now, this isn't about giving them a free ride. It's really a strategic move to encourage more of these mega IPOs. By easing that initial offering burden, the hope is to foster deeper market liquidity, make trading smoother, and obviously make India an even more compelling place for global capital. Chairman Tuhin Kanta Pandey, in that press briefing on September 12th, he put it quite clearly. He said these reforms aim to relax the ease of doing business. But crucially, without compromising investor safeguards, it's about optimizing the whole process.
Okay, and just to make sure everyone's crystal clear when we talk IPO, we mean that very first time a private company sells shares to the public. That's the moment it transforms into a publicly traded entity. It's a real rite of passage for a business. It funds expansion, rewards the early believers, investors, employees, and for many of us, it's that direct route to investing in companies we think might really shape the future. All right, so to really grasp the kind of strategic thinking behind these changes, we need to dive into the numbers a bit. Let's get into the core, these minimum public float norms, or MPO. Previously, like we touched on, it was a pretty rigid setup. Any company whose offer size was going to be over Everbella's 4,000 crore, what's that, about $500 million US?
Roughly, yes.
Yeah.
Around $480 million.
Right. So over that threshold, you had to offer at least 5% of your post-issue paid-up share capital in the IPO. And for smaller issues, it was even higher, 10% or sometimes 25%. You can see how this one-size-fits-all thing really became a bottleneck for the truly massive company.
A major hurdle.
Imagine a firm targeting, say, a $100 billion valuation. Being forced to offload 5% meant, putting $5 billion worth of stock onto the market instantly. That risks immediate price drops, huge volatility right from day one. Not ideal.
Not ideal at all.
Mm.
And that's precisely where SEBI's new framework comes in. It introduces this really sophisticated tiered approach. I like to think of it as a ladder of requirements. It's directly linked to the company's post-issue market capitalization, the MCAP. That's the total value of all its shares right after the IPO dust settles. So for the absolute titans, the giants company is expected to have a post-issue MCAP exceeding Rs $5 trillion. That's about $60 billion US.
Okay, so the very biggest.
The very biggest. For them, the minimum public offer drops dramatically, down to just 2.5% of their paid-up share capital.
Wow, 2.5%. That's a big drop from 5%.
It is. But importantly, it's not a free pass. There's a solid floor built in. Their offer still has to be at least Rs 15,000 crore, that's around $1.8 billion US, plus an additional 1% of that post-issue MCAP. So it ensures a really substantial amount of capital still comes in, and it scales with their enormous size, but it avoids completely overwhelming the market. Now, coming down that ladder a step, for firms with an expected MCAP between Rs 1 trillion and Rs 5 trillion, so about $12 billion to $60 billion, the rule changes. It's now the higher of either Rs 6,250 crore, which is about $750 million US, or 2.75% of the post-issue MCAP.
Okay, still pretty significant players.
Oh, absolutely. These are still incredibly large established companies. Then for companies at MCAP over Rs 5,500 crore, that's roughly $660 million US, up to that Rs 1 trillion mark. The minimum offer changes again. It goes from what was often a flat 10% requirement down to Rs 1,000 crore, $120 million US, plus at least 8% of the MCAP.
Yeah.
It's got a blended approach, recognizing the different needs even within that large cap space.
Right, lots more flexibility.
Exactly. And then for what you might call the smaller large caps, those between Rs 4,000 crore and Rs 50,000 crore MCAP, about $480 million up to $6 billion. The rules mostly stick around that existing 5% threshold. But now they're integrated neatly into this whole comprehensive tiered framework. And really importantly for the smaller issues, those under Rs 4,000 crore MCAP. Nothing changes there. The minimum stays at 10% or 25%. So existing protections for those smaller listings are maintained.
That makes sense. You don't want to change things too drastically at that end.
Precisely. This whole segmentation, this tiering, it's quite clever. It allows the market to absorb a much wider range of company sizes without getting swamped.
It really does feel like SEBI's approaching each listing with the kind of precision that fits its scale. You could almost compare it to like a tailor making a bespoke suit for someone versus just trying to shove everyone into the same off-the-rack size.
That's a great analogy.
And the real-world benefit for, say, a company with a trillion rupee MCAP is huge, right? They can now list with a much leaner initial offer. Maybe raise, I don't know, Rs 20,000 crore instead of being forced by the old rules to dump Rs 50,000 crore onto the market.
Exactly. That's about $2.4 billion versus $6 billion. It's a massive difference.
Which means they can keep more control initially, the promoters can.
Yes, retain more promoter control.
Raise plenty of funds for growth, but avoid those sudden, sharp shocks to their valuation right when they list.
Okay, but these reforms, they aren't just about that first big splash, that initial listing moment. What happens after a company goes public? Particularly around how much of the company needs to be owned by the public over time. We need to talk about this minimum public shareholding, or MPS requirement. Normally, once a company lists, it has to make sure that 25% of its shares are held by the public, right? And usually within 3 years.
That's the standard rule, yes. 3 years to get to 25% public float.
Which, for these absolute giants, must feel like a pretty tight squeeze. It can be, absolutely. And this is another area where SEBI has introduced really significant phased relaxation, specifically for these behemoths. So for companies whose post-listing market cap falls between Rs 50,000 crore, that's the $6 billion mark, and Rs 1 trillion, or $12 billion, that timeline to reach the 25% MPS, it gets extended out to 5 years instead of 3.
Okay, 5 years. Gives them more breathing room.
Definitely. And then for the truly massive ones, the companies exceeding that Rs 1 trillion MCAP, the timeline stretches out even further, to a full decade. 10 years.
Wow, 10 years.
Yeah, specifically the way it works is, if their public holding is under 15% when they list, they get 5 years just to hit that 15% mark. Then they get another 5 years after that to reach the full 25%.
That's a very gradual path.
Extremely gradual.
Yeah.
It really eases the pressure on the promoters, who often hold very large stakes initially, allows for a much more orderly divestment over time. And this actually mirrors practices you see in very mature markets like the US.
Yeah.
Think about big tech founders there. They often take many years to gradually reduce their stakes.
Right. It avoids forcing big blocks of shares onto the market too quickly.
Exactly. And Chairman Pandy mentioned these changes might apply prospectively, meaning only to new listings going forward. But there seems to be a strong chance they could be grandfathered, applied even to large IPOs already in the works once the government notifies the rules, just to ensure fairness for deals already moving.
Now, shifting gears slightly, but still on the theme of access, SEBI seems really committed to making sure everyone can participate, especially at the grassroots level. And that commitment, I thought, was shown really powerfully when they decided to reject a proposal that came up, a proposal to cut the retail investor quota in IPOs. Someone wanted to reduce it from 35% down to 25%.
That's correct. That proposal was considered.
But SEBI said no. Chairman Pandy was apparently quite emphatic about it.
He was. He stressed that retail participation is crucial for the orderly development of the equity market.
That sends a really clear signal, doesn't it? That everyday savers, individual investors, they won't get squeezed out by the big institutional players. The playing field stays level for them.
And another key piece here, related to institutional players, is the revamp for anchor investors.
Ah, yes, the anchors. The big funds that come in early.
Precisely. These are usually large institutional funds, domestic or foreign, that commit to buying a chunk of the IPO before it opens to the general public. They help stabilize the offer, provide confidence, signal a price point to the rest of the market. The cap on how much of the total offer they can take, that's been increased significantly, up to 40% now, from the previous limit, which is around 1/3 or 33%.
So a bigger role for anchors, potentially. Why that change?
Well, the thinking seems to be strategic. It aims to attract even more stable long-term international capital. These anchors provide really crucial pricing signals, especially for large, complex issues, and they can help reduce the risk of the IPO being underpriced.
Yeah.
You can think of anchors like the reliable ballast in a ship. The more secure and substantial they are, the steadier the voyage for the IPO itself.
That makes sense. A smoother launch.
We actually saw the impact recently. Swiggy's IPO, which was quite large, was reportedly oversubscribed, and a big part of that was apparently due to really strong early support from anchor investors.
And speaking of attracting foreign money, SEBI rolled out something with a pretty interesting name, SWAGOTFI.
Yes, SWAGOTFI.
Which stands for Single Window Automatic and Generalized Access for Trusted Foreign Investors. That's quite a mouthful.
It is, but the concept is powerful.
What is it exactly? Sounds like a fast track.
It's essentially designed to be just that, a streamlined, almost one-stop digital entry point for global capital flows into India. Think of it like a much more efficient visa office, specifically for trusted foreign investors wanting to participate in India's markets, making it much, much easier for them. And to support SWAGOTFI, there's also this ambitious India market access website that's being developed. The goal here is to consolidate all the relevant rules and guidelines from the various regulators, SEBI, the Reserve Bank of India, RBI, the insurance regulator, IRDAI, even tax authorities, all into one single, central, user-friendly online portal.
Okay, that sounds incredibly useful. No more hunting across different websites.
Exactly. This could be a real game changer. The expectation is that it could slash the time it takes for foreign portfolio investors, or FPIs, to get registered. What might have taken months before could potentially come down to just a matter of weeks.
Wow.
Which would be a significant boost for foreign direct investment, FDI, which, let's remember, is already hitting multi-year highs in India. Especially for low-risk FPIs, this just dramatically simplifies the whole process of engaging with Indian markets.
Okay, so we've talked IPOs, ongoing shareholding, investor access. But SEBI didn't stop there. They're also looking at strengthening the actual foundations of the market itself, right? Like new governance rules for the exchanges.
That's right. They've introduced new mandates, specifically for stock exchanges and other key market infrastructure institutions. The plumbing of the system, if you will. These institutions must now appoint 2 executive directors.
2? Why 2?
The idea is to enhance operational oversight, improve day-to-day management, and really bolster internal checks and balances. It's kind of like ensuring you have co-pilots in the cockpit of India's entire trading ecosystem. Just makes it more robust. And that's just one part of a whole suite of other quite targeted reforms they announced. For example, for alternative investment funds, AIFs. These are the funds typically dealing with accredited investors, right? High net worth individuals, sophisticated folks who understand risk.
People with like Rs 10 crore net worth, that sort of level.
Exactly. For AIFs dealing primarily with those investors, there's now going to be a lighter regulatory touch, less paperwork essentially, without compromising the core principles of transparency and disclosure, making it easier for them to operate. Another really pivotal change is how real estate investment trusts, REITs, and infrastructure investment trusts, INVITES, are classified.
Ah, REITs and invites. They've become quite popular for pooling money into big property and infra projects.
Very popular.
Yeah.
And now they're being formally reclassified as equity instruments.
What does that mean in practical terms?
Well, it opens the door for broader trading opportunities, potentially better tax treatment in certain scenarios, and generally makes them more integrated into the mainstream equity market. This could unlock literally trillions of rupees for India's booming real estate and infrastructure sectors. Think about funding all those new office parks going up in places like Bengaluru, or the massive highway projects being undertaken by the National Highways Authority of India, NHAI. This helps channel funds there.
Huge potential impact.
Absolutely. And linked to that, the definition of who counts as a strategic investor is being expanded. It will now include qualified institutional buyers, or QIBs. This allows more institutional muscle, think large insurance companies, pension funds, to come in and provide deeper long-term capital pools for various investments.
Okay, so broadening the base of big investors too. What else?
Mutual funds also get a bit of a break. The maximum exit load, the fee you pay for leaving a fund early, is being capped at 3% for liquid schemes, down from 5%.
Makes switching less painful if needed.
Exactly. Less punitive. Might encourage slightly longer holding periods too, especially when you see the incredible growth in systematic investment plans, SIPs. People are pouring money in regularly over Rs 20,000 crore, that's $2.4 billion, coming in every month now through SIPs.
Incredible numbers.
And one more thing, simplifying disclosures for related party transactions. These are deals between connected entities within a corporate group. For lower value transactions, specifically those under Rs 1,000 crore or 5% of turnover, the disclosure requirements are being eased. This cuts down on red tape for what are often routine, legitimate internal business dealings for large, honest conglomerates, freeing them up to focus on their core operations.
Wow. Okay, so when you put all these pieces together, the IPO changes, the MPS relaxation, swag at-fi, the governance tweaks, the AIFs, REITs, mutual funds, disclosures, when you zoom out, what's the big picture here? What does this whole package really signify?
I think it signifies a major push towards operational efficiency, absolutely, but also market maturation. It's about streamlining processes across the board, making the entire Indian financial ecosystem more robust, more responsive, and frankly, much more competitive on a global scale. And it helps to add a little historical context here too, India's capital markets, they've really come an incredibly long way from those old colonial-era trading floors through the exciting, but sometimes, let's admit, turbulent 1990s liberalization period.
Which included things like the Harshad Mehta scam.
Exactly. Events like that ultimately led to SEBI being given much stronger powers, becoming the effective regulator it is today. And now, fast forward to the present. We have this incredibly robust arena, over 7,000 listed companies. Market capitalization has proudly crossed the $5 trillion mark. India is now ranked 4th globally in terms of market cap.
Quite a journey.
It truly is. And these reforms feel like the next logical strategic step in that ongoing evolution, strengthening the foundations for future growth.
And the timing feels absolutely perfect, doesn't it? India's IPO pipeline, everyone's talking about it. It's just brimming with potential blockbusters. We're hearing about massive listings potentially coming down the track, like the National Stock Exchange itself, the NSE IPO.
Yes, the NSE IPO is highly anticipated.
Which could be valued potentially over $5 trillion. That's $60 billion.
The numbers being discussed are certainly in that league.
And listings like that, well, they've often faced delays, partly because of some of those older, more stringent norms we discussed. So by lowering these specific barriers for the mega IPOs, SEBI is sending this really clear, unequivocal signal, isn't it, to global investors, to big domestic companies.
The signal is loud and clear. India isn't just open for business, it's eager for big business.
Yeah. I saw projections from Reuters suggesting that overall IPO fundraising could top $20 billion this year, positioning 2025 to really be, as they put it, the year of mega IPOs.
That seems entirely plausible given these changes.
It's not just about the big numbers, though, is it? It feels like it's about unlocking a huge amount of latent potential that was maybe held back before.
I think the impact will be profound and felt across multiple fronts. Firstly, you'd expect significantly enhanced liquidity in the market, more shares trading freely, more easily. That usually means tighter bid-ask spreads, better price discovery, and less scope for manipulation.
Good for everyone involved.
Absolutely.
Yeah.
Secondly, it genuinely fosters more democratized access. Think about it. A young professional working in Mumbai, or maybe even a farmer out in a village in Punjab. They can now potentially access shares in one of these new infrastructure giants or a huge tech company with unprecedented ease, often just using simple apps like Grow or Zeroda right on their smartphone.
Bringing markets closer to the people?
Exactly. Thirdly, and this is crucial, it acts as a direct catalyst for economic growth. All this capital being raised, it gets channeled into critical high-growth sectors, renewables, electric vehicles, fintech, advanced manufacturing. This directly fuels job creation, spurs innovation, and helps propel the whole economy forward. And finally, as we touched on, these changes bring India's market practices much more closely in line with global standards. You look at markets like the US, the NYSE, the NASDAQ, they routinely host trillion-dollar companies with flexible listing norms. That attracts talent, it attracts capital from everywhere. India, with its massive population, its rapidly growing middle class, it's now explicitly positioning itself to compete for and attract that same level of global talent and capital.
Of course, no market journey is ever completely smooth sailing. We have to acknowledge the potential bumps. Market volatility is always a factor, right? Often driven by global events like shifts in U.S. Federal Reserve interest rates or geopolitical issues. Those kinds of things could certainly test some of these new large listings.
That's a very valid point. Global factors always play a role. But SEBI seems very aware of this. They have, as we discussed, bolstered market surveillance mechanisms. Those new executive directors at the exchanges are part of that, keeping a vigilant eye out for excessive volatility or manipulation. And crucially, let's not forget the retail protections. That 35% quota for individual investors, it remains untouched.
A key safeguard.
A key safeguard. It ensures that the everyday investor remains a core, protected participant in this growth story, preventing institutional players from completely dominating these big IPOs. Chairman Pandey reiterated this point. These are all carefully considered, meticulously designed steps towards making India, in his words, a more attractive investment destination. And that means attractive for every type of investor.
So if we were to distill the core essence of our conversation today, these decisions made by the SEBI board back on September 12th, 2025, they really are far more than just some regulatory tweaks or fine-tuning. They feel like a comprehensive blueprint almost for India's financial future, by strategically making it easier, more practical for corporate giants to go public, while at the same time really upholding investor trust and ensuring robust participation from retail investors. The regulator seems to be writing this really compelling story, a narrative where everyone from the ambitious founders building these massive companies right down to you, the everyday investor watching this, stands to participate and potentially win.
I agree completely. The markets, which are always this living, breathing mirror of a nation's economic health and its aspirations, well, they're now set to shine even brighter. It's like an open invitation for everyone to join this really exciting parade of progress that's unfolding in India.
So here's a final thought to leave you with. Just imagine the sheer scale of innovation, the job creation that could be unleashed now. When companies that might have been previously held back by older, more rigid rules can now tap into public capital with this kind of unprecedented ease. How might this start to reshape the global economic map? And what new giants might emerge from this fertile ground giants that you might have the chance to participate in?